My dear students, welcome back to our channel. In this video, I will be explaining the BBA first semester subject Financial Markets and Services as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is: define financial system. A financial system is a network that helps flow of money between people who have surplus money, savers, and people who need money, borrowers. It includes institutions, markets, instruments, and regulations that make borrowing, lending, and investing easier. Key components: 1. Financial institutions, banks, insurance companies, mutual funds. 2. Financial markets, money market, capital market, forex market. 3. Financial instruments, shares, bonds, debentures, government securities. 4. Regulatory authorities, RBI, SEBI, which ensure transparency and stability. Example: if a farmer needs a loan for seeds, he can borrow from a bank. If a company needs funds to expand, it can issue shares or bonds in the stock market. Investors can invest their savings in banks, mutual funds, or stocks. Importance: helps economic growth by moving money efficiently. Promotes investment, savings, and entrepreneurship. Ensures stability and trust in the financial system. Memory tip: think of a financial system as a money highway connecting savers, investors, and borrowers safely and efficiently. Next important short question is: to explain financial markets. A financial market is a place where buyers and sellers trade money, securities, and financial instruments. It helps mobilize savings and channel them into productive investments. In simple words, it's a market for money instead of goods. Types of financial markets. 1. Money market deals with short-term funds up to 1 year, example, treasury bills, commercial papers. 2. Capital market deals with long-term funds, example, shares, debentures, bonds. 3. Foreign exchange market, where currencies are bought and sold. Example: a company needs 10 crore rupees to build a factory. It can raise money by issuing shares in the stock market, capital market. A bank may lend short-term funds to another bank in the money market. Importance: helps efficient allocation of resources. Encourages investment, savings, and economic growth. Provides liquidity so investors can buy-sell easily. Memory tip: think of financial markets as bridges connecting savers and borrowers for short-term and long-term needs. Next important short question is: 3. Define RBI. The Reserve Bank of India, RBI, is the Central Bank of India. It was established in 1935 under the Reserve Bank of India Act. The RBI is the main authority responsible for managing India's currency, money supply, and credit system. It ensures financial stability in the country. Key roles of RBI. 1. Issuer of currency. Only RBI can print Indian currency notes. 2. Controller of credit. Regulates how much money banks can lend. 3. Lender of last resort. Provides emergency funds to banks in need. 4. Regulator of banks. Supervises commercial banks, cooperative banks, and other financial institutions. Example: if inflation rises, RBI can increase interest rates to reduce borrowing and control prices. During a bank crisis, RBI can lend money to keep the banking system stable. Memory tip: think of RBI as India's financial policeman, controlling money, credit, and banks to keep the economy safe and stable. Next important short question is 4. Define SEBI. SEBI, Securities and Exchange Board of India, is the regulatory authority for the securities market in India. It was established in 1992 to protect the interests of investors and ensure that the stock market operates fairly, transparently, and efficiently. Key roles of SEBI: 1. Protects investors, prevents fraud and unfair practices in the stock market. 2. Regulates stock exchanges, ensures companies and brokers follow rules. 3. Promotes development, encourages growth of capital markets and investment culture. 4. Monitors securities market, supervises trading of shares, debentures, and other financial instruments. Example: if a company tries to cheat investors by giving false financial information, SEBI can investigate and punish it. SEBI ensures that brokers do not mislead small investors while buying or selling shares. Memory tip: think of SEBI as the guardian of the stock market, keeping it safe and fair for everyone. Next Unit 1. Long questions. First important long question is 1. Explain structure of Indian financial system. The Indian financial system is a network that connects savers and borrowers through institutions, markets, instruments, and regulatory bodies. Its main purpose is to mobilize savings and allocate funds efficiently for economic growth. The structure of the Indian financial system can be broadly divided into 3 parts. 1. Financial institutions. These are organizations that collect savings from individuals and provide them as loans or investments. Banking institutions, commercial banks, cooperative banks, regional rural banks. Non-banking financial companies, NBFCs, LIC, mutual funds, insurance companies. Example: a person deposits 50,000 rupees in a bank and the bank lends part of it to a business for expansion. 2. Financial markets. These are platforms where financial instruments are bought and sold. Money market deals with short-term funds up to 1 year, example, treasury bills, commercial papers. Capital market deals with long-term funds, example, shares, debentures, bonds. Foreign exchange market, where currencies are traded. Example, a company issuing shares on the stock market raises funds to build a factory. 3. Financial instruments. These are tools to transfer funds between savers and borrowers. Equity shares, ownership in a company. Debentures, bonds, borrowed funds repayable with interest. Government securities, safe investment for public and banks. 4. Regulatory authorities. They ensure the financial system works smoothly, transparently, and safely. RBI, Reserve Bank of India, controls money supply, regulates banks. SEBI, Securities and Exchange Board of India, regulates stock market and protects investors. Importance of structure. Ensures efficient allocation of funds. Promotes investment, savings, and economic growth. Maintains stability and trust in the financial system. Memory tip: think of the Indian financial system as a money highway. Institutions is equal to roads. Markets is equal to bridges. Instruments is equal to vehicles. Regulators is equal to traffic police. All working together to move money safely and efficiently. Next important long question is 2. Explain the functions of financial system. A financial system is the backbone of any economy. Its main function is to connect savers, people with extra money, and borrowers, people or businesses needing money, so that funds are used efficiently. In India, The financial system performs several important functions. 1. Mobilization of savings. It collects savings from individuals, households, and businesses and channels them into productive uses. Example, a person deposits 1 lakh rupees in a bank, the bank lends it to a company for expansion. 2. Allocation of funds. It directs funds to sectors where they are most needed and can generate higher returns. Example, funds from small investors are used by companies to start new projects, creating jobs and boosting the economy. 3. Risk management. The financial system provides instruments to reduce and manage risks, such as insurance and derivatives. Example, buying insurance protects against losses from accidents, fire, or business failures. 4. Liquidity. It ensures that assets like shares, bonds, and government securities can be easily converted into cash. Example, selling shares on the stock exchange provides instant cash when needed. 5. Price determination. Financial markets help in determining prices of financial assets through demand and supply. Example, share prices in the stock market reflect the performance and future prospects of companies. 6. Facilitates payments. It supports a smooth flow of payments through banks, checks, online transfers, and digital wallets. Example, using UPI or NEFT for daily transactions makes money transfer fast and secure. 7. Economic growth. By mobilizing savings, allocating funds, and promoting investments, the financial system supports industrial growth, infrastructure development, and overall economic progress. Memory tip: think of the financial system as a money manager. Collects savings, allocates efficiently, provides safety, ensures liquidity, supports growth. Next important long question is: 3 types of financial markets. A financial market is where funds are exchanged between savers and borrowers. In India, financial markets are classified into different types based on time, instruments, and purpose. 1. Money market. Definition: deals with short-term funds up to 1 year. Purpose: provides liquidity to businesses and government for short-term needs. Instruments: treasury bills, T-bills, commercial papers, CPs, certificate of deposit, CDS, call money. Example, a company needs 5 crore rupees for 6 months. It borrows in the money market through commercial papers. 2. Capital market. Definition: deals with long-term funds, more than 1 year. Purpose: helps companies raise capital for expansion and growth. Instruments: shares, debentures, bonds, government securities. Submarkets. Primary market, where companies issue new shares, bonds to raise funds. Secondary market, where existing securities are traded, stock exchanges like NSE and BSE. Example, a company issues shares in the primary market to build a new factory. Later, investors buy and sell these shares in the secondary market. 3. Foreign exchange market, Forex market. Definition: where currencies are bought and sold. Purpose: facilitates international trade, investment, and tourism. Example, a company importing machinery from the USA buys dollars in the Forex market. 4. Derivatives market. Definition: deals with contracts based on the value of assets like stocks, commodities, or currencies. Purpose: helps in hedging risk. Instruments: futures, options, swaps. Example, a farmer can lock the future price of wheat using a futures contract to avoid losses due to price changes. Importance of financial markets. Efficient fund allocation. Provides liquidity and risk management. Supports economic growth. Memory tip: Think of financial markets as different lanes of a money highway. Money market is equal to fast lane, short term. Capital market is equal to long lane, long term. Forex market is equal to international lane. Derivatives is equal to safety lane for risk. 4. Explain the objectives and functions of Reserve Bank of India. 4. Explain the objectives and functions of Reserve Bank of India, RBI. The Reserve Bank of India, RBI, is the Central Bank of India, established in 1935. It acts as the regulator, controller, and guardian of the country's financial system. Its main objective is to maintain monetary stability and economic growth. Objectives of RBI: 1. Control inflation, keeps prices stable by regulating money supply. 2. Ensure financial stability, maintains confidence in the banking system. 3. Promote economic growth, facilitates credit to priority sectors like agriculture, industry, and small businesses. 4. Regulate credit, ensures funds are available to productive sectors while avoiding excessive lending. Functions of RBI: 1. Issuer of currency. RBI is the only authority allowed to print and issue Indian currency notes. For example, 500 rupees and 2000 rupee notes are issued by RBI. 2. Lender of last resort, provides emergency funds to banks facing liquidity crisis. For example, during a banking crisis, RBI can lend money to prevent collapse. 3. Regulator of banks and financial institutions, supervises commercial banks, cooperative banks, and NBFCs to ensure safety and soundness. 4. Control of credit and monetary policy, uses tools like repo rate, reverse repo rate, cash reserve ratio, CRR, to regulate money supply. For example, increasing repo rate reduces borrowing and controls inflation. 5. Foreign exchange management, manages foreign currency reserves and maintains exchange rate stability. For example, RBI buys/sells dollars to prevent rupee from falling sharply. 6. Public debt management, helps government raise funds by issuing bonds and securities. Importance: maintains economic stability, promotes growth and development, ensures trust and confidence in the banking system. Memory tip: think of RBI as India's financial policeman and banker, controlling money, helping banks, and keeping the economy safe. Next important long question is: 5. Explain the objectives and functions of SEBI. SEBI, Securities and Exchange Board of India, is the regulatory authority of the securities market in India, established in 1992. Its main objective is to protect investors, ensure fair practices, and promote the development of the capital market. Objectives of SEBI: 1. Investor protection, prevents fraud and unfair practices in the stock market. 2. Market development, encourages transparency, efficiency, and growth in the securities market. 3. Regulation of market intermediaries, ensures brokers, mutual funds, and companies follow rules. 4. Promote fair trading, maintains confidence in the stock market. Functions of SEBI: 1. Regulation of stock exchanges and intermediaries, supervises brokers, sub-brokers, mutual funds, and other participants. Example: SEBI ensures brokers do not cheat small investors while trading shares. 2. Protecting investors, takes action against companies giving false information or manipulating prices. Example: if a company publishes fake profits to attract investors, SEBI can investigate and penalize it. 3. Regulating corporate finance, approves issuance of shares, debentures, and IPOs to maintain transparency. Example, a company issuing shares in the primary market must follow SEBI guidelines. 4. Promoting market development introduces reforms like dematerialization of shares and electronic trading to make markets safer and efficient. 5. Monitoring insider trading prevents unfair advantage due to unpublished price-sensitive information. Importance: builds trust and confidence in the stock market. Encourages more people to invest safely. Ensures efficient and transparent capital markets for economic growth. Memory tip: think of SEBI as the guardian of the stock market, like a traffic police for shares, making sure everyone follows rules and trading is safe.